Taxes are already a major issue in the Republican presidential primary.
It's not good for the economy. That's what's very clear.
For millions of working class Americans, taxes would shoot up, widening America's already massive income gap.
You may think that your largest expense is buying an expensive car or house, but in reality, your largest expense are your taxes. Every year, the money that you make from January 1st to March 31st goes to the IRS. So wouldn't it be cool to learn how to pay less taxes? Hey everyone, my name is Sean and I make real estate easy. And the reasons why I love real estate is because of the appreciation potential, the monthly cash flow we get every month, and the amazing tax benefits that we get from owning real estate. And in today's video, I'll show you how to legally pay $0 in taxes with real estate. By following these steps, you'll learn how to properly invest in real estate so that you can minimize your taxes and keep more of the money with your family instead of paying it all to the IRS. One of the best ways to pay less taxes is to fully utilize the ability of the 1031 exchange. Normally when you buy and sell an investment, the government will charge you taxes on the profit you made from the sale. So as an example, if I bought a property for $100,000 and then sold it a few years later for $150,000, then the government will tax me based on the $50,000 of profit that I made. Now how much tax they're going to charge me is based on my income. So based on where you are in the income bracket, that's going to determine how much capital gains taxes you're going to have to pay, which will be either 0%, 15%, or 20%. And not to mention any additional capital gains taxes that you may have to pay depending on what state you live in. And while it is possible to pay 0% in capital gains taxes when you sell, you need to have made under $47,025 for the entire year in order to qualify for this. So for most people, expect to pay 15 or 20%. So on a sale of $150,000 or $50,000 out of profit, you'd have to pay either $7,500 or $10,000 in federal taxes alone, which is a lot of money. However, smart investors don't just sell a property and take the cash. Instead, they do a 1031 exchange where they sell a property and then roll over all the funds into a newer, more expensive property. This allows them to defer paying capital gains taxes on the property they just sold until they sell the next property that they just bought. For example, if I sold the $150,000 property and did a 1031 exchange instead of taking that money, then instead of only $140,000 to buy my next one, I can use the entire $150,000 to buy the next property. Now you might be thinking, why is this great if I still have to pay the taxes after I sell the next property? The thing is, you can just do another 1031 exchange in the future. And there's no limit to how many times you can do a 1031 exchange. So as long as you never sell a property without doing a 1031 exchange, you never have to pay those taxes. And if you're worried that the government will collect those taxes from your heirs when you pass away, you're in luck because when you pass away, your heirs will inherit the property with a step up in basis to the current market value. So let's say your grandma bought a property a long time ago for $100,000 and it's now worth $1 million. If she sold the property the day before she passed away, then she would have to pay capital gains taxes on the $900,000 of gain that she made during her lifetime. And that can be $180,000 if she's in the 20% tax bracket. And that's a lot of money. But if she passed away and gave you the property's basis would now be at $1 million instead of $100,000. So that means that if you sold that property that very same day for $1 million, then you have to pay $0 in capital gains taxes. This is because when the basis was stepped up, it was as if you bought the property at $1 million. So if you bought a property at $1 million and you sold it at $1 million, there's no profit to be taxed on. And even if you held onto it for a little bit longer and the value increased to like $1.1 million, then you'd only have to pay taxes on the additional $100,000 because that was all that increased after you inherited the property. This is a huge way to save on taxes. It keeps way more money in the family instead of giving it to the IRS. So now that you heard all the benefits, you may be thinking that doing a 1031 exchange is a no-brainer, but you still need to understand all the rules in order to fully utilize it. For one, to do a 1031 exchange, it has to be a like-kind investment. You can't do a 1031 exchange by selling real estate and then buying stocks. These are two separate things. But if you're selling real estate to buy another kind of real estate, then that qualifies. For example, you can sell a single family home and buy another single family home. Or you can sell a single family home and convert it to a fourplex. Sell a fourplex and buy land. This is all okay. Another thing to note is that when you sell a property, there are very strict timelines that you have to adhere to. Otherwise, the 1031 exchange will not go through and you have to pay capital gains taxes on all the gains you made since you first started exchanging. So the first timeline is that you have to identify the 3 properties that you're going to be actively looking at within 45 days of closing on the first property you're going to exchange. And the reason they make you do this is so that you're not infinitely shopping. You're actually targeting specific properties. And the reason why they give you 3 things to look at is because they understand that not every deal you pursue will go through. Maybe you're trying to buy one deal and then you don't come to agreement with the seller, or you find something during escrow. So by giving you these 3 options, you still have 2 backups if one falls through. But after day 45 has passed, you can't choose any more options, and the 3 ones that you chose, if them all fallen through, then again, you're out of luck. The second key timeline is that you have to close on the next deal within 180 days of you selling the first property. So if you sold the property on January 1st, you basically have until June 30th to finish everything, close on the deal, and this timeline is incredibly strict. The IRS is not going to care if there are some random seller delays or delays in your financing and you close on day 181. If you don't close on day 180, then you're going to cancel your 1031 exchange and then you pay capital gains taxes on all the profits you've made on this deal since you started exchanging way back in the day. So these two timelines are very, very important, so make sure you stay on top of them. Another thing to be aware of when doing a 1031 exchange is to make sure that you're actually buying something that is more expensive than what you're selling. If you do end up having to buy something a little bit cheaper than you sold, it's not the end of the world, but you will have to pay capital gains taxes on anything that you get back from the sale. You also can't sell a property with a mortgage and then buy something with less debt. Any kind of conversion that has less of your equity in the next deal or less debt in the next deal will give you something called a boot, which you will have to pay taxes for. And these rules are a little bit complicated, but that's okay because that brings us to the next part of doing a 1031 exchange, and that is working with a qualified intermediary. When you want to do a 1031 exchange, you can't just tell a title company, hey, I want to do a 1031 exchange and expect this whole thing to go through. You have to work with a qualified intermediary to facilitate your 1031 exchange officially. What they're going to do is they're going to take the sale proceeds from the sale of your first property, hold on to them, and help you buy your next property. By doing it this way, the government knows that you're not just taking the money and running and doing whatever you want with it. A good qualified intermediary will help you make sure the entire process goes smoothly and will even help you give guidance if you need it. If you're considering the sale of an investment property, why would you want to give up half of your gains to taxes? Before you simply sell, you want to get in contact with the sponsor of today's video, Equity Advantage. Equity Advantage is a qualified intermediary that has specialists in taxation, contract law, escrow, and real estate to make sure your 1031 exchange goes smoothly. And unlike other firms that simply process paperwork, they understand that the process of selling a property can be confusing. So they're easily accessible by phone to offer in-depth consultation and personalized solutions. And if they think a 1031 exchange is not for you, they'll let you know at no cost. The company was started by two real estate investors, David and Tom Moore, back in 1991, and has since helped thousands of investors with their 1031 exchanges. And besides common delayed 1031 exchanges, they can help with more complicated transactions like reverse exchanges, blended, leasehold, and improvement exchanges. The Advantage team also structures self-directed IRAs, 401k plans, and rollover business startups. So if you're selling an investment property, selling a personal home for more than the $250,000 or $500,000 exclusion, using retirement funds to buy an investment property, or if you're buying from a seller who doesn't want to pay on tax, then reach out to Equity Advantage at 1031exchange.com to find out the best way to sell your home and pay less taxes. Now, the next way that people don't pay taxes with real estate is through depreciation. It may be thinking, depreciation sounds like a bad thing. Am I losing money from owning real estate? The thing is, depreciation is a paper loss, which means that you're losing value on paper. But in reality, most real estate actually gains in value and appreciates over time. Now, the government does tell us that as years go by, the structure of a property does get older and the useful life of this thing is 27.5 years. And you may not know it, but when you buy a property, the value is actually split into two parts. Part of it is for the land and part of it is for the structure of the home on top of the land. So you can depreciate the value of the structure, but you can't depreciate the land because land doesn't depreciate. So as an example, let's say you bought a property for $500,000, where $200,000 of that is for the land itself and $300,000 is for the structure. So to calculate how much you can write off every year, take the $300,000 that the structure is worth and divide that by 27.5. And this amount is how much you can deduct from your profits every single year as a passive expense. So again, you're not actually spending any money on depreciation, but you get to pay less taxes because of it. And for a $300,000 structure, you can deduct $10,909 every year for it. So let's say you made $2,500 a month on this property, or $30,000 a year. Now, before you pay a tax on that $30,000, you subtract all of your expenses. So let's say you pay 8% a month for your property manager, which ends up being $200 a month or $2,400 a year. And if you pay $5,000 a year for property taxes and $1,500 for insurance, then you subtract another $6,500 from that number, and then subtract any interest you pay on your mortgage or any repairs you pay on your property. Then subtract an additional $10,909 because of depreciation, and the final number is what you actually have to pay tax on. And as you can see, being able to write off an additional $10,000 for your taxes is a huge benefit. And finally, another way of paying less taxes because you now own real estate is by having all these additional write-offs you get. Since real estate investing is a business, anything you buy for the business is now a write-off. And there are some very interesting things that you can write off because you own real estate. For example, besides just writing off the common things like repairs or paying your property manager, you can write off things like paying for your flights to visit your property. For example, we have properties in Florida. So when I go to Florida to visit my properties and meet with my property management team, I can write off my flights, I can write off my meals, and my transportation while I'm there, as well as my hotel stays. And while I'm in Florida, if I happen to swing by Disney World on the way there, then it's all good because most of my trip was to go visit my properties. Now, if you also happen to run your operations and your real estate deals from a room in your home, you can now take advantage of a home office, and you can write off a portion of your rent, your mortgage interest or utilities because you use a part of your home as a home office. And the cool thing about all this is that you don't even need an LLC to start. When you start investing as a real estate investor, you're in business and you can start taking those deductions. Now, of course, I highly recommend that you speak to a local tax professional before implementing all these things, but these are just ideas that you can start using to start paying less taxes. So these are the main ways that real estate investors are paying $0 in taxes. And it's actually very simple. The first way is to buy properties and then continuously 1031 exchange them when they sell them until they pass away and leave them all to their heirs. This way, no one has to pay any capital gains taxes. And the other way is by expensing more things, taking depreciation against the rents you get from your properties. So by the end of it, even though they made a lot of money from the rental income, they basically pay no taxes because of all the deductions. So thanks again for Equity Advantage for sponsoring this video. If you guys are thinking of selling a property and you want to learn how to pay less tax when you do, then definitely check them out at 1031exchange.com or with the link down below. And if you guys have gotten this far, then definitely check out this video where I teach you how to invest in real estate from scratch. Thanks for watching. I appreciate you and I'll see you next time. Take care.